Hi, my name is Faisal Khurshid. I'm a principal at IG Private Wealth Investors Group Securities Inc. Today, my goal is to review first quarter market review presented by Philip Peterson, Chief Investment Strategist at IG Private Wealth Management. A tough start, a more promising finish. The first quarter of 2022 was a stark contrast to the way market ended in 2021. Many equity indices suffered a correction. Bond yield climbed sharply, meaning price fell. While central banks started along their path to interest rate normalization, perhaps the most shocking event in the quarter was the invasion of Ukraine by Russia. The devastation by Russia against Ukraine was a key catalyst to the volatility in equity, fixed income, and commodity markets. Equity market peaked in first week of the year, falling through early March. Technology stocks bore to burn the correction action, and with the Nasdaq Composite Index falling by as much as 21%. By the dip mentality of investor allow for equity index to part the losses by quarter end. Equity Canadian equity were the outlier as oil and other commodity drove the S&P TSX Composite Index to new highs. Commodity prices inflation was exacerbated by the conflict in Ukraine and sanctions against Russia, driving energy and agriculture prices higher. Oil reached as high of $123 per barrel US before closing the quarter just above $100 per barrel US. Year over year, inflation accelerated during the quarter. In Canada, the consumer price gained CPI gained 5.7% in February, fastest pace of inflation since 1991. In the United States, the CPI gained 7.9, its highest since 1982. The stronger and more persistent inflation has resulted in a strong pivot by central banks to a more hawkish stance. During the quarter, the Bank of Canada, US Federal Reserve, and Bank of England each raised its benchmark rate while signaling many more hikes to come through 2022. Bond yield, both government and corporate, responded in kind, rising across markets in North America, Asia, Europe, and Asia. In index returns, in S&P TSX, as indicated earlier, provides a positive return in Q1. It ended the quarter at 3.14% up. S&P 500 in Canadian dollar was down 6.20. MSCI EAFE was down 7.84 in Canadian dollar. MSCI Europe was down 9.62% in Canadian dollar. MSCI Emerging Market was down 8.55% in Canadian dollars. On a fixed income side, on chart 2, FTSE Canadian All Government Bond was down 7.16. FTSE Canadian Universe Bond was down 6.97%. ICE Bank of America US Corporate Bond was down 8.77 in Canadian dollar. ICE Bank of America US High Yield Composite was down 5.58 in Canadian dollar. Barclay Global Aggregate Bond was down 6.16 in US dollar. In Canadian equities, the S&P TSX Composite Index continued to advance during the quarter, largely owing to the energy sector. The index reached all-time high on March 29, finishing the quarter just slightly below it. Gains were seen across seven sectors as indicated in chart 2, led by the energy and material. The crude uh, the price gained 33 during the quarter, owing the tight global supply and geopolitical risk. The information technology sector lagged as the tech stocks were weighted down by rising rate environment. US equity, excluding the bear market of 2020, S&P 500 index suffered its first correction since 2018. Not surprisingly, the most expensive stocks were the hardest hit. By the end of the quarter, only the energy and industrial sector managed gains. Despite being down as much as 13% during the quarter, S&P 500 index managed to regain more than half of the losses by quarter end. The Nasdaq Composite Index saw great graded downside by as much as negative 21%, with the higher valuation tech stock being marked down in the face of higher interest rate. So, as you can see in chart 4, the energy was the most performing sector in US. International equity fell during the quarter due to the weaker growth in China and the increased risk the geopolitical disruption from the war in Ukraine. Shanghai, China financial capital, and its population of 25 million were put into partial lockdown at the end of the quarter in an effort to curb surge in COVID-19. Weaker Chinese stock performance weighted on the emerging market index. Europe tied to Ukraine and Russia for much of its energy import was negatively impacted by the war. Fixed income. Bond market were down during the quarter as higher inflation drove yield higher, along with the central bank expectation. Canadian and other fixed income benchmark were down sharply as yield rose. US high yield and investment grade corporate bonds are also fell during the quarter. Bank of Canada, US Federal Reserve, Bank of England each raised their respective benchmark rate during the quarter, while signaling a series of increases in 2022 in a bid to tamp down inflation. Key benchmark performance in 2020 first quarter, like US dollar ended the first quarter at 0.7995 to US dollar, crude ended at 100.28 in US dollar, gold ended the quarter at 1937 in US dollar, and natural gas ended the quarter in 5.65 in US dollar. After early equity correction, moderate growth is expected for the rest of the year. Economic view through the remainder of 2022 is that growth is very likely to moderate from the rapid pace of 2021 or more normalized environment. Some areas world faces additional headwind that could potentially see much slower growth. In particular, Europe is at risk of recession, given the economic disruptions stemming from the Ukraine war. China also faces economic headwind due to its effort to restrict spread of COVID-19 by locking down major cities. North America, meanwhile, continues to show decent economic momentum within the manufacturing, housing, and labor markets. Despite the weaker start of the year, the equity outlook over the next 12 months has improved. Equity market valuations are more attractive following the corrective action in the first quarter. Corrections are part of the normal functioning equity market. While uncomfortable historically, correction outside of a recession have presented an attractive entry point for investors. Canadian equities, which have enjoyed a strong start of the year, are positioned to benefit from commodity prices inflation. The bond market will continue to be focused on inflation and the shift in monetary policy by central banks. Inflation, now proven to be much more persistent, is likely to moderate somewhat more but remain at a higher than average level throughout the year. Interest rate hikes are expected as each policy meeting throughout the remainder of the year for Bank of Canada and US Federal Reserve. Bond market have largely priced in most of the interest rate increases. As such, further gain in yield are likely to be more modest than a first quarter. Overall, aside from the uncertainty of geopolitical risk, the outlook for remainder of 22 looks promising. Thank you very much for your time. If you guys have any questions, please reach out to me, Jen, or Clayton Lane. We are happy to assist you. Have a wonderful day.